Hello everyone, this is Adrian. Welcome to the Property Playbook. Today we're going to talk about lending, and I have my friend here, Carrie Sanford from the Bay Area Funding Group, to talk about her job and what are some challenges within this business and what works for you. So Carrie, how are you doing?
Great. Good morning, Adrian.
Morning.
Thanks for having me.
Yeah, thank you for coming. Tell me a little bit about yourself and how long have you been in the industry?
I work for Bay Area Funding Group out of Danville primarily and throughout the Bay Area. I've been in the business since 1986, so I've seen lots of trends, times in which home purchases were very busy, and then times where things slowed down a bit due to different things, rates, economy, that type of thing.
So what do you see the difference between, maybe 2 years ago when it was a frenzy to maybe a year ago and now?
2 years ago, interest rates were probably at the lowest level in history. Inventory was decent.
Oh.
There were quite a few homes coming on the market and so forth. Still not quite enough for the amount of demand that we had. But during that time, rates were so low that affordability was there for people.
Right.
So April of last year, interest rates started to increase. And at first, following that time, homes were still coming on the market, buyers were still buying. But what I noticed pre-qualifying borrowers was when they would call and I would go over rates with them and payments, and suddenly interest rates were maybe in the 5s instead of the 2s.
Right.
A lot of these buyers went silent. They just weren't prepared or ready for that jump in interest rates. So that transition took place for 6 or 8 months, where there was this shock factor.
Yeah.
And what I'm seeing now is that buyers are prepared. They understand that rates are in the 6s to the 8s, depending on what type of transaction they're doing. And it's just a matter of now having low inventory, right? Still having plenty of buyers, and those buyers being able to get into a property in their price range, which, by the way, is lower now than it would have been.
Yeah, so would you say like the typical buyer now are more sophisticated, sharp, and ready? And when they see the property, they're gonna jump immediately? Or, what do you think?
I think that buyers that prepare in advance are ready when they find that right property. Buyers that haven't taken those first steps to figure out, like, what do payments really look like? How much cash do we need? That type of thing. They find the property they like, and then there's still a lot of work to do before they can really jump on it.
Let's just say for a first-time home buyer, or, if they're preparing for, buying their second property, what would you do in their shoes to get prepared and stuff?
As a first-time home buyer, there's a couple of things to do on your own at first, such as, figure out, like, where do you want to live?
Right.
Like, what do you think that price range looked like? Look at maybe go through some open houses, different things, and perhaps find a great real estate agent through friends or family or podcasts such as this that you might want to talk to and work with. And then from there, talk to a lender. So at this point, your realtor that you're going to be working with, you have an idea of your price point. How can you make that happen? So then by talking to a lender, you're able to get the pre-approval process started.
Right.
And we actually work through, credit and income and what type of assets are being used for the down payment. And surprisingly, sometimes certain assets aren't even eligible, like cash. If you have cash under the, in a mattress or whatever, we can't use that.
Because it has to be on the tax return, right?
Assets need to be documented.
Right.
So, and there's certain sources of funds that are eligible and certain sources of funds that are not.
Right.
So it's important to have your full financial picture looked at by a lender so that you know the things that might need to be worked on.
Right.
Or if everything's in order, at least you know your price range. You can work on different scenarios. For instance, typically when I qualify a borrower, I can qualify them for more than they actually feel comfortable with paying.
Okay.
So where I start is by qualifying a client or a borrower to the maximum level and talk about payments and cash requirements, and then work our way down from there.
Gotcha. So what they're comfortable with.
Exactly.
Right.
So, okay, your payment's going to be, on $1 million home, your payment's going to be $8,000 a month, and we need $250,000 to, to make that happen. But this client might only feel comfortable with $6,000 a month. Right? And $185,000 or things like that. So we start with the max and then we wiggle it down and fit them into the box that they're comfortable with. And then back to their realtor, right? With the specific details.
Okay. So what are some methods that a buyer could do to prepare and maybe qualify for even higher loan amount?
In the process of preparing, and again, if they speak to a lender or someone like myself, will lay out these plans for them. But paying down consumer debt,
okay,
you know, a $500 car payment could translate into $50,000 worth of borrowing power. So don't go buy a car when you're getting ready to look for a home. Do that after you buy your home. Paying down credit card debt. Student loans, not so much. I would focus on revolving credit before even considering student loans. Saving. But at the same time, I would say the target shouldn't be saving 20% down to buy a home, because the national average is about 7 years to reach that goal. And in recent history, equity and appreciation has far exceeded the ability to save that 20% over that 7-year period. So save and have a benchmark, 3.5% down, 5% down, 10% down, and save along those lines. Maintain good, excellent credit.
Okay. So what are some common mistakes that you see a buyer make before, during, and after the transaction? Before
a transaction is assuming what they can qualify for. It's always different. During a transaction is taking steps and doing things without letting your lender know. So when we pre-approve you or your buyers, different things like that, we specifically work with current income, current employment, current assets, or assets that we know are forthcoming, like gift funds from family, 401k loans, things like that. And then credit. What is your debt? So we qualify you on that basis. Following that, if a borrower goes out and back to the buying a car, buys a car, it's completely going to change the picture. If they deposit large amounts of money into their bank account, cash, undocumented, if they sell a car and do not document it, different things like that will cause issues, because we can only use acceptable and documented funds. So cash cannot be deposited into your bank account. We have to deduct that off. So let's say a borrower deposits $20,000 in cash, but they're using that $20,000 in cash to pay off a student loan. Great, the student loan's gone now, and the $20,000's gone now. But guess what? We have to deduct that $20,000 off from their remaining assets. So now we even have less funds to work with. So a mistake during the process is taking any step without letting your lender know. So that we can guide you. There's always a way to make these financial transitions happen, but we need to be involved.
And what about, like, you know, when they get a new job or switching jobs or, you know, getting a pay raise? Will that, like, affect?
Employment changes are really an important item to discuss with your lender. So if switching jobs, you actually do not have to start the job before you close on a new home purchase. We just have to have a job offer letter. And we'll work off of that job offer letter, provided the start date is within 60 days of closing, typically. There may be a little bit of variance there. Going from being employed to self-employed, that's a huge one. Because you have to be in self-employed 2 years to use the income for qualifying, so definitely don't want to do that. Increase in wages is going to increase your borrowing power, so that's going to help.
And how big of a job gap that you shouldn't have? Like, what's the maximum job gap?
In the past, we were required to document a 2-year history of employment, current and consecutive. But now the guideline is 2 years employment history over time. So there's not a specific timeline for that. So I would say 5 years, you know, being currently employed with at least a 2-year history over 5 years.
So how can a borrower get creative with their loan options?
Loan programs are for the most part, all primarily built around adjustable rate loans or fixed. So those are always going to be the options. Fixed rate loans are typically a conventional type of loan product with pretty set guidelines.
Right.
And obviously fixed rates provide for a payment that's never going to change. Adjustable rate loans a lot of times offer additional qualifying features because these oftentimes are portfolio loans with their own sets of guidelines. For instance, if you have a borrower that wants to buy a home before they sell their current home, okay, there's a qualifying issue, right? Especially in the Bay Area. How do we qualify for, the mortgage payment on our home that we live in now, and also the mortgage payment that we live in that we're going to have on the new property? So with that, we have a portfolio loan option that allows us to omit the payment on the departing residence. So in that scenario, we can set your client up to have a HELOC up to 70% of the value of their home, which can be used to purchase the new property, and the payment on the departing property, including the HELOC, will not be included in qualifying at all. This is an example of a portfolio loan that would be like a 7-1 ARM. A loan that's fixed for 7 years, then adjustable. So portfolio meaning that whoever's lending those funds has their own set of guidelines, which will typically be expanded from the typical conventional guidelines. Another option is for self-employed borrowers that, a lot of times cash-based businesses, their tax returns are not going to report enough income to qualify. So for borrowers like that with decent credit, we can use deposits on 12 months of their bank statements and qualify their income using the deposits to their bank account versus. So for self-employed borrowers who have basically cash-based businesses, a lot of times the tax returns will not report enough income to qualify. So in that case, we'll generally take a look at business bank statements for 12 months and we'll use bank statement deposits as a source of income for qualifying. So those types of loans are typically available on adjustable rate loans as well, but also fixed rate loans under the portfolio platform, but with slightly higher interest rates.
Gotcha. So what are some, programs that might benefit first-time home buyers?
So first-time home buyers earning under 120% of the median income in whichever county that they're buying, right off the bat, they're going to have better interest rate options than a non-first-time home buyer or a first-time home buyer earning more than 120% of median income. And depending on the details of their transaction, whether they're purchasing a single family or a condo, or if they have low credit scores versus high, these differences in rates could be, up to even 1% better. So definitely interest rate options for first-time home buyers. Down payment assistance. Cal HFA is a big one in California, and the typical program allows for up to a 3% down payment or 3.5% when we're using government financing, and in some cases up to 2 or 3% of the sales price as a third piece of the puzzle that will help with closing costs. So there are income limits. This is a first-time home buyer loan program. And the funds are typically available. Home buyers classes to have to be taken to be qualified for this. For home buyers that I qualify that are short on funds needed for the down payment and so forth, I'll offer this as an option for them.
Gotcha. Okay. Yeah. So, and then after this podcast too, I'll provide Carrie's, information so that if you guys have any other questions, feel free to reach out to Carrie at any time. Okay. And then the last question is, do rates always matter?
Rates matter from a qualifying standpoint because the rate determines the payment, and the amount of payment compared to income is how we qualify you. But as far as whether or not you should buy or not buy due to rates, I would say the rate shouldn't matter. Just be sure that you can afford what you buy. But in California especially, inventory has been low for a long time. There's more home buyers than properties. So what's that saying? Marry the property, date the rate.
Right.
Something like that. So you've got your property. If rates are higher now, you can always lower that monthly payment later when rates go down, or if they go down.
Yeah, exactly. Because you're dating, or you're like married to the home, because you love the home. You know,
Right.
it's hard to find that one home. But rates, you know, when it gets better, just refinance or something. You know, there's other options to, you know, lower your, you know, monthly mortgage payment. But as long as you love the home, stick with it, you know, because that's a long-term investment, but rather than, you know, like a short-term thing, which is rates are typically, you know, they're more in the short term. So yeah, marry the house, date the rate.
Yeah, and there's also the thought that when rates go down, there's going to be more buyers out there again, and even it may be even harder to get a home at that point.
Yeah.
So at that point, you don't have a property, but you may be paying more for that property, even though you're getting the lower rate. So buy now, hopefully at a lower price than in the future. Refinance later based on that
Correct.
home that you've purchased at the lower price.
Because honestly, when I see rates go back down again, 99% of homes across America, they have locked in their mortgage rate that is under par right now. So a lot of times not everyone is motivated to sell because, you know, their home is at such a great rate. And once rates start lowering, there's not enough inventory, and what we're gonna see is probably a bloodbath of what 2 years ago. You know, people are gonna start bidding, you know, fighting for homes, you know, $100,000-$200,000 above asking. It's crazy. So, you know, marry the home, date the rate. You know,
Right.
simple as that.
Right.
So,
And when things are in your pocket, so you know your price range, you know what the rates are, when you feel comfortable at that level, be serious when you're writing an offer. Don't try and undercut it. Try and get that property.
yeah.
You know, how many buyers have we seen over the last few years that, you know, started and they were able to get what they wanted at, let's say $1 million, right, in the Bay Area 3 years ago. But they weren't seriously preparing those offers based on even helpful guidance from realtors as far as what, you know, what range you might think they need to be in to get that offer accepted. And then a year later, then all of a sudden that same property's what?
Yeah, way above.
Way above.
Yeah.
Rates are higher.
Yeah.
So I think that your time is when you feel comfortable with everything that you're capable of doing. Do it.
Yeah.
And then just, you know, see if things get better over time.
Just do it.
Yeah, just do it.
Alright, so that's all the time that we have for today. Thank you, Carrie, for coming by and, you know, give us your knowledge. You know, right below here, I'll have Carrie's contact information. So if you guys have any question, feel free to reach out to Carrie. She's very responsive and awesome. So yeah, if you guys like this, please feel free to subscribe, and I'll see you next time.